Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This presentation is for educational and informational purposes only. The information provided is not intended as a substitute for professional advice. You should always consult with a qualified and licensed professional before making any decisions about your own insurance coverage. Your specific needs and circumstances are unique, and the details of policies can vary significantly by state and by provider. Let me tell you about a friend of mine. Let's call him Mark. Mark is a smart guy. He's a software engineer, runs marathons, a guy who seems to have it all together. A few months ago, he was sitting at a red light, scrolling through a podcast on his phone, when bam, a car behind him, a kid texting and driving, failed to stop and plowed right into his bumper. It wasn't a catastrophic crash, but the damage was significant. The trunk was crumpled, the taillights shattered. Annoying, but that's what insurance is for, right? Mark wasn't worried. He pays about $150 a month for what he calls full coverage. So he exchanged information, called his insurance company, and filed the claim. The next day, the adjuster called. The car would need at least a week in the shop. Okay, Mark said. So how do I get the rental car? The adjuster's reply was a punch to the gut. Well, sir, looking at your policy, you don't have rental reimbursement coverage. Mark was stunned. What? I told the agent I wanted full coverage. The adjuster was polite but firm. Full coverage isn't an actual insurance term, sir. It's just a phrase people use. You have liability, collision, and comprehensive, but the rental reimbursement endorsement was declined. That rental car ended up costing Mark over $500 out of his own pocket. But the pain wasn't over. A few days later, the body shop called with the repair estimate, $4,500. Mark called his insurance company, ready to get it approved. The adjuster said, "Okay, we've approved the repair. We'll be sending a check for $3,500. Mark was confused. Wait, what about the other $1,000? And that's when he learned his second brutal lesson. He had a $1,000 collision deductible. He had to pay the first $1,000 of the repair himself. In the span of a week, a not-my-fault accident that he thought he was fully covered for cost him over $1,500 cash, right out of his bank account. Mark's story isn't a rare one-in-a-million tragedy. It's happening in some form to thousands of people across America every single day. And it happens for one reason. Almost nobody actually reads or understands their auto insurance policy. Let's be honest, that packet of paper they mail you, or that 40-page PDF they email you, might as well be written in a foreign language. It's dense, it's confusing, and it's filled with legal jargon that feels designed to put you to sleep. But here's the billion-dollar secret. That confusing document is one of the most important financial contracts you will ever sign. It's a legal agreement that can either protect your entire financial life or, if misunderstood, lead you straight into bankruptcy. The good news is you don't need a law degree to understand it. You just need a guide. You need someone to show you exactly where to look and what to look for. And that is exactly what we are going to do right now. In this video, I am going to give you the decoder ring. We are going to tear apart your auto insurance paperwork piece by piece, and I'm going to translate it into plain English. By the end of this, you will be able to look at your own policy with confidence, spot the gaps that could cost you a fortune, and know for certain that you and your family are properly protected. So where do we start? We start with the single most important part of your entire policy. The first 1 or 2 pages. This is called the declarations page. Think of the declarations page as the cheat sheet for your entire policy. While the rest of the policy is a dense forest of legal definitions and exclusions, the deck page is the map. It summarizes everything. Who is covered, what is covered, when you're covered, and for how much. If you only read 1 page of your policy, this is it. So grab your own policy if you have it, and let's walk through it together. The first thing you'll see at the top is the named insured. This is you, the person who owns the policy. It might also list your spouse. This is critical. Anyone listed here is the primary person covered. Below that, you might see drivers. This is where you list anyone else who regularly drives your vehicles, your teenage kids, a partner, maybe a roommate. Now here's your first action item. Look at that list. Is everyone who regularly drives your cars on it? If your 17-year-old son, who just got his license, isn't listed and he gets into an accident, your insurance company could have grounds to deny the claim. It's a simple detail that could cost you everything. Next, you'll see the vehicles. It should list the year, make, and model of every car on your policy. along with its vehicle identification number, or VIN. Double-check this. A single typo in a VIN number can create a nightmare during a claim. Make sure every car you own and expect to be covered is listed there accurately. Then you'll find the policy period. This is the time frame you're covered for. Usually a 6-month or 1-year term. It has a start date and an expiration date. The most important thing here is to never ever let it lapse. A lapse in coverage, even for a single day, makes you a higher risk. Your rates will skyrocket when you go to get a new policy, and if you get into an accident during that lapse, you are 100% on your own. Now we get to the heart of it. The part that really matters. The coverages. This is a list of what you're actually paying for, and it's usually laid out in a series of lines with dollar amounts next to them. This is where the confusion begins, and this is where we're going to bring clarity. The first thing you'll see is liability coverage. This is the one coverage that is legally required in almost every state. Liability does not pay for you or your car. It pays for the damage you do to other people and their property. It's usually shown as 3 numbers, like 50/100/50. This can look like code, but it's simple. The first number is the maximum amount. In thousands, the policy will pay for any one person you injure in an accident. In this case, $50,000. The second number is the maximum amount it will pay for all injuries in a single accident. Here, $100,000. The third number is the maximum it will pay for property damage, that's the other person's car, or maybe a fence you hit, in this case $50,000. Here is the most dangerous trap on the entire page: state minimums. Many people, to save money, just buy the minimum liability coverage their state requires. This is financial suicide. Many state minimums for property damage are as low as $10,000 or $15,000. Think about that. The average price of a new car today is nearly $50,000. If you have a $15,000 limit and you total someone's brand new Ford Explorer, your insurance will pay the $15 grand, and then the other driver's insurance company will sue you personally for the other $35,000. They will garnish your wages, put a lien on your house, and ruin your financial future, all to save $10 a month on your premium. Do not fall into this trap. Next, you'll see uninsured or underinsured motorist coverage, often abbreviated as UM/UIM. This is one of the most important coverages you can have. This protects you when the person who hits you either has no insurance or has cheap, state minimum insurance that isn't enough to cover your medical bills. 1 in 8 drivers in America is on the road illegally with no insurance. This coverage is what pays for your hospital bills and lost wages if one of them hits you. It's not for your car. It's for your body. Then there's medical payments or personal injury protection, often called MedPay or PIP. This is also for you. It covers initial medical expenses for you and your passengers after an accident, regardless of who is at fault. It's designed to pay quickly for things like ambulance rides, ER visits, or health insurance deductibles without having to wait for a long legal battle to determine fault. Finally, we get to the coverages for your car. This is what most people think of as full coverage. It's 2 separate things: collision and comprehensive. Collision is simple. It pays to repair or replace your car if you hit something. Another car, a pole, a tree. It doesn't matter whose fault it is. Comprehensive covers damage from almost everything else: theft, vandalism, a rock cracking your windshield, a tree falling on your car, hitting a deer. It's the other than collision coverage. Next to both collision and comprehensive, you will see the word deductible. This is the number that cost my friend Mark $1,000. The deductible is the amount of money you have to pay out of pocket for a repair before the insurance company pays a single dime. A higher deductible, like $1,000 or $2,000, will give you a lower monthly premium. But you have to ask yourself a hard question. If you got into an accident tomorrow, could you easily write a check for that amount? If the answer is no, you need to lower your deductible. That small savings on your premium isn't worth the massive financial shock of a high deductible when you can least afford it. This is the ultimate pay me now or pay me later scenario, and you need to be honest with yourself about what you can handle. Now, being honest with yourself about that deductible is step 1. But what happens when the accident isn't about your car or your injuries? What happens when you are the one at fault? This is where we move from the inside of your wallet to the outside world. We need to talk about the absolute, non-negotiable bedrock of your entire auto insurance policy: liability coverage. If your policy is a fortress, liability coverage is the giant outer wall. It's not there to protect you directly. It's there to protect you from the financial catastrophe of harming someone else or their property. Every single state, with the exception of New Hampshire's quirky alternative rules, legally requires you to have it. And on your declarations page, you'll almost always see it listed as a series of 3 numbers, separated by slashes. Something like 25/50/25, or 100/300/100, or maybe even 250/500/100. For years, people have stared at these numbers, their eyes glazing over, having no earthly idea what they mean. They just know they have them. Today, that confusion ends. These 3 numbers are the most important numbers on your entire policy, because they represent the absolute maximum amount of money your insurance company will pay out to others when you cause an accident. Let's break it down using a nightmare scenario. Imagine you're driving home after a long day. You're tired. You glance down at your phone for just a second to check a notification. When you look up, traffic has stopped. You slam on the brakes, but it's too late. You rear-end the car in front of you. A brand new SUV with a family inside. The first number in that sequence, let's say it's 100/300/100, is your bodily injury liability limit per person. In our example, that's $100,000. This is the absolute maximum your insurance will pay for the medical expenses of any single person you injure. The father driving the SUV has severe whiplash and a broken wrist. His medical bills, physical therapy, and lost wages come out to $60,000. Great, you're covered. Your policy pays the 60 grand. But now we look at the second number. That's your bodily injury liability limit per accident. In our example, that's $300,000. This is the total absolute maximum your policy will pay for the medical expenses of everyone you injure in a single accident combined. Let's say the mother in the passenger seat also had injuries totaling $50,000, and one of their kids in the back had a concussion and needed a hospital stay, costing another $40,000. The grand total for the whole family's medical bills is 60 plus 50 plus 40. $150,000. Since that total is less than your $300,000 per accident limit, and each individual's cost was less than your $100,000 per person limit, you're still okay. Your insurance company writes the checks. You are financially shielded. But what if the accident was worse? What if the father needed major surgery, and his bills alone were $180,000? Your policy has a $100,000 per person limit, pays the first $100,000 and then it stops. Where does the other $80,000 come from? Comes from you, your savings, your investments, your future wages. And what if the total for the whole family was $400,000? Your policy has a $300,000 per accident limit, pays $300,000 and then it stops. Where does the other $100,000 come from? Again, it comes from you. They will sue you, and they will win because you were at fault. Courts can and will garnish your wages for years, put liens on your property, and seize your assets to make that family whole again. This is why choosing your liability limits is so critical. Many people just ask for the state minimum. This is, without a doubt, one of the most dangerous financial gambles you can take. State minimums are terrifyingly low. In some states, the minimum for bodily injury per person is just $25,000. Think about that. One night in an emergency room after a serious accident can cost more than that. You could financially ruin yourself and someone else by trying to save $8 a month on your premium. Now for the third number. That's your property damage liability limit. In our 100/300/100 example, that's $100,000. This is the maximum your policy will pay for any property you destroy. Notice it doesn't say car. It says property. You hit that brand new $65,000 SUV and totaled it. Okay, your $100,000 limit covers that. But what if, when you hit it, you pushed it into the car in front of it, causing another $15,000 in damage? Now you're up to $80,000. And what if you also skidded off the road and took out a custom-built brick mailbox and a fancy wrought iron fence? That's another 10 grand. You're at $90,000 in property damage. You're still covered. But again, look at the state minimums. Some states only require $15,000 or $25,000 in property damage coverage. The average price of a new car in America today is nearly $50,000. If you have a $25,000 limit and you total an average new car, you are personally on the hook for the other $25,000 right out of the gate. That's before we even talk about hitting a Tesla, a Porsche, or a commercial vehicle. You could be financially underwater before the tow truck even arrives. The rule of thumb is simple. Your liability limit should be high enough to protect your net worth. If you have $100,000 in savings and home equity, You need at least that much in liability coverage because that's what you stand to lose in a lawsuit. For most people, I strongly recommend limits of at least 100/300/100, and if you can afford it, 250/500/100 is even better. The price difference to raise your limits from the state minimum to a truly protective level is often shockingly small. We're talking about the cost of a few cups of coffee a month to protect yourself from a lifetime of debt. So, we've covered the damage you do to other people and their things. That's the big scary part. But in that accident, your own car is a wreck. The front end is crumpled, the radiator is leaking, and it's not going anywhere. Liability coverage does absolutely nothing for your own vehicle. Zero. For that, you need to look at the next section of your policy, the part that covers physical damage to your car. This is where we meet the two coverages everyone has heard of, but so many people confuse: collision and comprehensive. Think of them as two different shields that protect your car from different kinds of threats. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a tree, a guardrail, a pothole, or the wall of your own garage. The key word is collision. If your car hits something, this is the coverage that kicks in. And remember that deductible we talked about earlier? This is where it lives. If you have a $1,000 deductible and you cause $2,500 in damage to your car by backing into a pole, you pay the first $1,000, and your insurance pays the remaining $1,500. Simple as that. Comprehensive coverage, on the other hand, is sometimes called other than collision coverage. It's the shield for almost everything else, the random, unpredictable events that can damage your car. A hailstorm turns your car's roof into a golf ball? That's comprehensive. A tree branch falls on your hood during a windstorm? Comprehensive. You hit a deer on a dark country road? Surprisingly, that's comprehensive, not collision, because the deer is an animal, not a stationary object you collided with. Fire, theft, vandalism, flooding. All of these fall under the comprehensive umbrella. And just like collision, this coverage almost always has a deductible that you choose. Often, people choose a lower deductible for comprehensive because the claims are typically less severe and less likely to be their fault. So, liability protects everyone else from you. Collision and comprehensive protect you from the world. You need to look at your declarations page and see what you have. Do you have both? If you have a loan or a lease on your car, the answer is almost certainly yes because your lender requires it. But if you own your car outright, it's your choice. If you're driving an old beater worth $1,500, paying for collision coverage might not make sense. The cost of the coverage plus your deductible could be more than the car is even worth. But if you're driving a car you can't afford to simply replace with cash tomorrow, you absolutely need both. But what happens in a situation that isn't so clear-cut? What if someone else hits you, and they're the one with the pathetic state minimum coverage that can't even cover the damage to your new car? Or even worse, what if they don't have insurance at all? They just shrug and say, "Sorry, I'm broke." Now you're the victim, you've done nothing wrong, and you're staring at a massive repair bill and mounting medical expenses. You might think you're completely out of luck, but you might not be. Hiding on your declarations page are two of the most important, yet most overlooked coverages you can possibly have. They are your secret weapon against the irresponsible and the uninsured. And that is exactly what we are going to break down next. Let's start with the scene. You're driving home from work, maybe listening to a podcast, thinking about what's for dinner. The light ahead turns green. You proceed through the intersection, just like you've done 1,000 times before. And then out of nowhere, bam! A car runs the red light and plows directly into your driver's side door. The world is a blur of crunching metal and shattering glass. When things finally stop spinning, you're hurt. Your car is totaled. An ambulance is on its way. At the scene, the other driver is apologetic. They admit it was their fault. The police report confirms it. You think, okay, this is awful, but at least their insurance will cover it. And then the officer gives you the news that makes your stomach drop to the floor. The other driver has no insurance. Not a penny. Suddenly, you are staring at a mountain of medical bills. A car that's a worthless heap of metal, and potentially months of lost wages from being unable to work. And the person responsible has nothing to give you. You can sue them, sure, but you can't get blood from a stone. You are completely on your own. Unless you have uninsured motorist coverage. This is the first secret weapon hiding on your declarations page. Uninsured motorist, or is coverage you buy on your own policy to protect you from drivers who illegally drive without any insurance. Think of it this way. UM coverage allows your own insurance company to step into the shoes of the at-fault, uninsured driver and pay you for the damages they caused. It's your shield against the millions of people who break the law every single day by getting behind the wheel with no coverage. Now, UM coverage typically comes in two critical parts. The first is uninsured motorist bodily injury, or UMBI. This is arguably the most important coverage you can have, period. If you are hit and injured by an uninsured driver, UMBI pays for your medical expenses. We're talking about the ambulance ride, the emergency room visit, hospital stays, surgeries, physical therapy, and rehabilitation. But it goes even further. It also covers your lost wages if you can't work because of your injuries. And in the most tragic cases, it provides for things like pain and suffering or funeral expenses. This is the coverage that protects your health, your family, and your financial future from being destroyed by someone else's irresponsibility. The second part is uninsured motorist property damage, or UMPD. This one is more straightforward. It pays to repair or replace your car if it's damaged by an uninsured driver. Now you might be thinking, wait a minute, doesn't my collision coverage do that? And you're right, it does. But using your UMPD has a couple of huge potential advantages. First, the deductible for UMPD is often much lower than your collision deductible. We're talking maybe $250 instead of $1,000. Second, and this is a big one, making a claim under your UMPD is far less likely to raise your insurance rates because the accident wasn't your fault. You're simply using a coverage you paid for to protect yourself from a lawbreaker. So that's the first threat, the driver with zero insurance. But there's another, more subtle danger lurking on the roads. It's the driver who has insurance, but only carries the bare minimum required by the state. This brings us to our second secret weapon, underinsured motorist coverage, or UIM. Let's go back to our crash scene. Same scenario. You're seriously injured, your car is totaled, the other driver is 100% at fault. But this time they have insurance. You breathe a sigh of relief. The problem is, they only have the state minimum liability coverage. In many states, that might be just $25,000 for bodily injury. You get to the hospital, you need surgery on your back, you're out of work for 6 months. Your total medical bills and lost wages easily top $100,000. The at-fault driver's insurance company writes you a check for their policy limit, $25,000. And that's it. That's all they are legally required to pay. You are now left with a $75,000 gap, $75,000 that you are personally on the hook for. Your life has been turned upside down, and the responsible party's insurance barely made a dent. This is where underinsured motorist, or UIM coverage saves the day. It's designed specifically for this gap. After the at-fault driver's insurance pays out its maximum limit, your UIM coverage kicks in to cover the rest, up to the limits you selected on your own policy. So, in our example, if you had $100,000 in UIM coverage, it would pay that remaining $75,000 difference. It's the ultimate safety net. It ensures that you aren't punished financially because the person who hit you decided to be cheap and carry a tiny, inadequate policy. So here's what I want you to do. Pause this video if you have to, and go grab your auto insurance declarations page. Right now, look for the section on uninsured and underinsured motorist coverage. You'll probably see it abbreviated as UM/UIM. You should see two sets of numbers just like your liability coverage. The first number is the per person limit. The second is the per accident limit. Here is the single most important piece of advice I can give you. Your UM/UIM limits should be, at a minimum, identical to your own bodily injury liability limits. Let me repeat that. The amount of coverage you have to protect yourself and your family should be the same as the amount you have to protect a stranger. If you've chosen to protect your assets with $250,000 in liability coverage in case you cause an accident, why on earth would you choose to only have $25,000 in coverage to protect yourself if someone else does the exact same thing to you? It makes no sense. The cost to increase these limits is usually shockingly small, sometimes just a few dollars a month for a massive increase in protection. But we can take this a step further. For those of you with more than one car on your policy, there's a power-up called stacking. In states that allow it, stacking lets you combine the UM/UIM coverage limits for each car on your policy. Let's say you have 2 cars and you have $100,000 of UM/UIM coverage on each. If you have stacked coverage and you get into an accident, you now have $200,000 of available coverage. 3 cars, $300,000. It multiplies your protection. Choosing to stack your coverage costs a little more, but it is one of the most powerful ways to create a financial fortress around your family. Your declarations page will explicitly say whether your coverage is stacked or non-stacked. If it's non-stacked, you should call your agent immediately and ask for a quote to change it. You might be wondering, if this is so important, why isn't it the default? Why doesn't every agent scream this from the rooftops? The truth is, it's a conflict of interest. Your insurance company is a business. UM/UIM claims are situations where they have to pay large sums of money directly to you, their own customer. It's a direct hit to their bottom line. It's much more profitable for them if you're underinsured in this area, because it limits their potential payout. They are legally required to offer it to you, but they have very little incentive to make sure you understand just how crucial it is. You cannot control other people. You can be the safest, most defensive driver in the world, but you share the road with people who are texting, people who are drunk, and people who simply don't care enough to buy adequate, or in some cases, any insurance at all. Uninsured and underinsured motorist coverage isn't about your driving skills. It's a policy on the bad decisions of others. It's making sure that when that bad decision intersects with your life, it doesn't also get to destroy your finances. But UM and UIM coverage is only one part of the medical protection puzzle. There's another, equally critical coverage hiding on your policy, one that pays for your medical bills regardless of who is at fault in an accident. It can be the difference between getting the care you need immediately or waiting weeks while insurance companies fight over blame. And understanding how it works with your health insurance is one of the most confusing, yet vital parts of this entire process. We're going to untangle that web next. So let's start with a scenario. You're in an accident. It's not a catastrophic one, but it's serious enough that an ambulance is called. You're shaken up, maybe have a broken arm, and you're on your way to the emergency room. The last thing on your mind is the bill, but that bill is coming. The ambulance ride alone can cost over $1,000. The ER visit, the x-rays, the doctor's time, it adds up, and it adds up fast. Now, who pays for all of this? Your first thought is probably, my health insurance, of course. And you're not wrong, but you're also not entirely right. Because in the world of auto insurance, there's a specialized frontline defender for your medical costs. And depending on your state, it's called one of two things: medical payments coverage, or MedPay, or personal injury protection, also known as PIP. Think of these as the paramedics of your policy. They show up first, they act fast, and their only job is to handle the immediate medical aftermath for you and your passengers, regardless of who was at fault for the accident. This no-fault aspect is the absolute key. It's what separates a manageable situation from a financial nightmare. It means your own insurance company starts paying your medical bills right away, without waiting for a lengthy investigation to determine if you or the other driver was to blame. That is a game changer. Let's break them down. We'll start with MedPay, since it's more common across the country. Medical payments coverage is an optional coverage in most states that pays for reasonable and necessary medical and funeral expenses for you and your passengers after an accident. Let's underline that. You and your passengers. We'll come back to why that's so important. The coverage extends to your family members who live with you, whether they're in your car or someone else's. It even covers you if you're hit by a car while you're out for a walk or riding your bike. It's a shield that follows you. What does it pay for? The ambulance ride, the emergency room visit, x-rays, surgery, follow-up appointments with specialists, physical therapy, even dental work if your teeth were damaged in the crash. It's designed to be a rapid response fund for your health. Now let's talk about its bigger, more comprehensive sibling, personal injury protection, or PIP. If you live in one of the dozen or so no-fault states like Florida, Michigan, or New York, you don't have a choice. PIP is mandatory. And it's a good thing because it's MedPay on steroids. PIP covers everything MedPay does: the hospital bills, the doctor visits, but it goes much, much further. The most significant addition is lost wages. If you're injured and can't work for a few weeks, or even a few months, PIP can help replace a portion of your lost income. This is massive. A broken leg doesn't just come with a hospital bill. It comes with the inability to earn a paycheck. PIP bridges that gap. It can also cover what are called replacement services. Say you're the primary caregiver for your children, and you're laid up for a month. PIP can help pay for childcare. If you can't mow your own lawn or clean your house because of your injuries, it can help pay for someone to do it for you. It's designed not just to heal your body, but to keep your life running as smoothly as possible while you recover. Okay, so now we get to the core of the confusion, the question that tangles everyone up. If I have really good health insurance, why on earth would I need MedPay or PIP? It's a fair question. You're already paying a hefty premium for health coverage. Why pay for it again on your auto policy? The answer lies in how these different types of insurance work together, and who pays first. This is the concept of a primary versus a secondary payer. In the vast majority of cases involving a car accident, your MedPay or PIP coverage is the primary payer. Your health insurance is the secondary payer. This means your auto policy is the first one to step up to the plate and start paying bills. Only after you've used up all of your MedPay or PIP coverage does your health insurance company get the call. And this order of operations is unbelievably important for three major reasons. First, deductibles, copays, and coinsurance. Your health insurance plan almost certainly has a deductible. That's the amount you have to pay out of pocket before your insurance starts covering anything. For many people, that's $2,000, $3,000, even $5,000 or more. If you rely solely on your health insurance after a car accident, you are writing a check for that full deductible amount before you see a dime from them. But MedPay and PIP? They typically have no deductible. They are first dollar coverage. The moment you have a $1 bill, they start paying. So, if you have a $5,000 MedPay limit, it can pay for your first $5,000 of medical bills, which might just happen to be the exact amount of your health insurance deductible. You effectively use your auto policy to pay off your health insurance deductible for free. Second, network restrictions. Most health insurance plans are HMOs or PPOs, meaning you have to see doctors and go to hospitals that are in-network to get the best coverage. If you go out of network, you pay a lot more, or you might not be covered at all. After a car accident, you might not have the luxury of choosing an in-network ambulance or emergency room. You go where you need to go. MedPay and PIP don't care about networks. They pay for reasonable medical care, period. They give you the freedom to see the specialist you want to see, not just the one your health plan dictates. And third, and this is the one that most people never consider, your passengers. Let's say you're driving two coworkers to lunch. There's an accident and everyone is hurt. Your health insurance covers you and only you. It does absolutely nothing for the other people in your car. Now you're in an incredibly awkward and potentially friendship-ending situation. Your coworkers are facing their own medical bills, their own deductibles, and they're looking at you. If you have MedPay or PIP, this problem vanishes. Your policy covers the medical bills for everyone in the car, up to the policy limit. No questions asked about fault. It is an act of financial goodwill. It protects your relationships as much as it protects your wallet. You are taking responsibility for the people you've invited into your vehicle. So how much do you need? Look at your declarations page. You'll see a line for medical payments or personal injury protection. The amount listed is typically the per-person limit. Common levels are $1,000, $2,500, $5,000, or $10,000. For PIP, the required minimums vary wildly by state, from $10,000 in some states to unlimited lifetime benefits in others. A great rule of thumb for MedPay is to carry, at a minimum, an amount equal to your health insurance deductible. If your deductible is $5,000, get at least $5,000 in MedPay. The cost to add this coverage is usually shockingly low. We're often talking about the price of a couple of coffees per month. It is one of the best bargains in all of insurance. If you look at your policy and you see that you've waived or rejected this coverage, I would urge you to call your agent today and ask for a quote to add it. This coverage is your immediate financial first aid kit. It's what you use on the scene, in the ambulance, and at the hospital to stop the financial bleeding before it even starts. It ensures that the first question you ask after an accident is everyone okay? And not, how are we going to pay for this? But this is only one side of the medical coin. MedPay and PIP are for you and your passengers. What happens when you are at fault and the people in the other car are injured? Their medical bills, their lost wages, their pain and suffering. Your MedPay does nothing for them. For that, you need an entirely different type of coverage. This is where the numbers get big. Really big. We're moving from covering a few $1,000s in your own ER bills to potentially being responsible for hundreds of thousands, or even millions of dollars in damages to someone else. This next section of your policy isn't just about a hospital bill. It's about protecting your house, your savings, everything you've worked for, from being wiped out in a single moment. And it all comes down to two little lines on your declarations page. Those two little lines are your liability limits, and they represent the absolute maximum amount of money your insurance company will pay out if you cause an accident. This isn't coverage for your car. It's not for your hospital bills. This is the money that stands between you and financial ruin when you are found at fault. It's the shield that protects your assets from the person you just hit. Let's break it down. You'll see it written as a series of 3 numbers separated by slashes. Something like 25/50/25 or 100/300/100. It looks like code, but it's the most important code on the entire page. The first number is the bodily injury liability limit per person. This is the maximum amount your policy will pay for any single person's medical expenses if you injure them in an accident. The second number is the bodily injury liability limit per accident. This is the total maximum your policy will pay for all medical expenses combined, for everyone you injure in a single accident, no matter how many people are hurt. And that third number? That's your property damage liability limit. This is the maximum your policy will pay to repair or replace any property you destroy. That means the other person's car, but it could also mean a guardrail, a telephone pole, a storefront, or even a multi-car pileup you caused. Now, here is the single most dangerous financial trap that millions of Americans fall into. They look at these numbers, see that they meet their state's minimum requirement and think, great, I'm covered. This is like bringing a garden hose to a skyscraper fire. Let's tell a story. Let's talk about a guy named Dave. Dave is a good driver, a responsible guy. He has a decent job, a modest home, some money saved up for his kids' education. He's driving home from work on the freeway. It's raining. He glances down for just 2 seconds to change the podcast on his phone. In those 2 seconds, the car in front of him slams on its brakes. Dave reacts, but it's too late. He hydroplanes and rear-ends a brand new Lexus SUV. The impact shoves the Lexus into the next lane, where it clips a minivan carrying a family of 4. The minivan spins out and hits the concrete median. It's a bad accident, all caused by a 2-second distraction. The police report comes out. Dave is 100% at fault. Now let's look at the bill. The Lexus is a $55,000 vehicle. With the frame damage, the insurance company declares it a total loss. The minivan needs $20,000 in repairs. That's $75,000 in property damage right there. But that's just the metal. In the Lexus, the driver has severe whiplash and a concussion. His initial hospital visit, MRI, and follow-up care total $40,000. In the minivan, the father has a broken arm, and one of the children has a fractured collarbone. Their combined medical bills hit $80,000. And the mother, who was in the passenger seat, has a more serious back injury requiring surgery and months of physical therapy. Her bills are projected to exceed $150,000, not to mention the wages she'll lose from being unable to work. Let's add it up. $75,000 in property damage, and a staggering $270,000 in medical bills, and that number is still climbing. The total financial damage from that 2-second glance is well over $345,000. Now let's look at Dave's insurance policy. He had the I'm covered mindset. He bought his state's minimum required liability coverage, which we'll say is 25/50/25. Let's see how that garden hose works on this skyscraper fire. The first number, 25, is for bodily injury per person. The woman with the back injury has bills of $150,000. Dave's insurance company writes her a check for $25,000. That's it. That's the max. She is still short $125,000. The second number, 50, is for bodily injury per accident. The total medical bills for everyone were $270,000. Dave's insurance company will pay a maximum of $50,000 to be split among all the injured people. They pay the $25,000 to the woman with the back injury, and the remaining $25,000 is split between the driver of the Lexus and the rest of the family in the minivan. After that $50,000 is gone, there are still $220,000 in unpaid medical bills. The third number, 25, is for property damage. The total damage to the cars was $75,000. Dave's insurance company writes a check for $25,000. That's the max. There is still $50,000 of vehicle damage unpaid. So, after Dave's I'm covered insurance policy pays out, there is still a grand total of $395,000 in outstanding bills. Where does that money come from? Comes from Dave. The lawyers for the injured parties don't just shrug and walk away. They file a lawsuit, not against Dave's insurance company. They already paid the maximum required by the contract. They file a lawsuit against Dave personally, and they will find his assets. They'll put a lien on his house. They'll garnish his wages, taking a percentage of every single paycheck he earns for years, maybe even decades. They'll seize the money in his savings account. That college fund he built for his kids? Gone. His retirement account? Gone. Every asset he has worked his entire life to build is now on the table to pay for a 2-second mistake. All because he chose the cheapest option on those 2 little lines. This isn't a scare tactic. This happens every single day in every state in this country. State minimum liability insurance is designed to be the absolute legal bare minimum you can have to operate a vehicle. It is not designed to actually protect you in a serious accident. Now imagine Dave had a different policy. Instead of 25/50/25, he had a 250/500/100 policy. It sounds like a huge jump, but we'll get to the cost in a minute. Let's run the scenario again. Property damage was $75,000. His policy has a $100,000 limit. The insurance company pays the entire bill. Check. Medical bills. The woman with the back injury needed $150,000. His policy has a $250,000 per person limit. The insurance company pays her entire bill. Check. The total medical bills for everyone were $270,000. His policy has a $500,000 per accident limit. The insurance company pays all the bills for everyone involved. Check. The lawyers never call Dave. His wages are never garnished. His house is safe. His kid's college fund is safe. He's shaken up. He'll have to pay his deductible for his own car, and his insurance rates will go up. But his financial life is not over. He is not ruined. His family's future is secure. That is the difference. That is what you are actually buying. And now for the most shocking part. The price difference between Dave's catastrophic 25/50/25 policy and the 250/500/100 policy that saved his entire financial future? In many cases, it's less than the cost of a few cups of coffee a month. $20, maybe $30 more per month to increase your protection by a factor of 10. There is no better return on investment for your own peace of mind. So I want you to do something right now. Pause this video, grab your declarations page, and look at those 3 numbers. Look at your liability limits. Ask yourself, if you made a 2-second mistake tomorrow, are you holding a garden hose or a fire truck? Is that number a real shield? Or is it a piece of paper that just makes you legally compliant while leaving everything you own completely exposed? You've built a financial life for yourself. You've worked hard for your home, for your savings. The liability section of your auto insurance is the fortress wall you build around all of it. And having state minimum coverage is like building that wall out of cardboard. So you've done the right thing. You've increased your liability limits. You've built that fortress strong and high to protect your assets if you're ever at fault. But what happens when the tables are turned? What happens when the person who plows into you at an intersection is the one driving with nothing but a prayer and a state minimum policy? Your hospital bills are piling up, your car is totaled, and their insurance runs out almost immediately. That's when you discover the most misunderstood, and potentially the most important coverage you can possibly buy. It's called uninsured and underinsured motorist coverage. And it is, without a doubt, the single most powerful tool you have to protect yourself and your family from financial ruin on the road. Let's be very clear about what this is. This is not insurance for the other guy. This is insurance you buy for yourself that steps in and pretends to be the other driver's high-limit insurance policy when they have little or none at all. It's a shield. It's your financial bodyguard. Let's go back to that nightmare scenario. You're in the hospital. The other driver, the one who ran the red light, had a state minimum policy. Let's say your state requires just $25,000 in bodily injury liability per person. That $25,000 was vaporized the second the ambulance doors closed. It barely covered the initial emergency room visit, but your total medical bills are climbing past $100,000. You need surgery. You need physical therapy. You're out of work for months, so you've lost your income. The other driver's insurance company sends you a polite letter saying they've paid out their policy limit of $25,000, and they wish you the best. That's it. They're done. So who pays the remaining $75,000 in medical bills? Who pays for your lost wages? You could sue the other driver personally, right? Sure. You can spend thousands on a lawyer to go after a person who could only afford the cheapest insurance legally allowed. You'll win a judgment in court, a piece of paper that says they owe you $75,000. But you can't get blood from a stone. If they don't have the money, they don't have the money. That piece of paper is worthless. So you're left holding the bag. A life-altering accident, through no fault of your own, has now put you on a path to bankruptcy. But what if you had underinsured motorist bodily injury coverage? Let's say when you bought your policy, you didn't just get the minimum. You chose a limit of $100,000 for your underinsured motorist coverage. Now look what happens. The other driver's insurance pays their $25,000. Then your insurance company steps in. They see the remaining $75,000 in bills. And because you had the foresight to buy this coverage, your policy pays that $75,000. Suddenly, you're not ruined. The hospital gets paid. The doctors get paid. You can focus on healing instead of fending off debt collectors. This one-line item on your policy just saved your financial life. It acted as a safety net that the other driver failed to provide. And that's just the underinsured part. What about the uninsured part? The statistics on this are terrifying. The Insurance Research Council estimates that 1 in 8 drivers on the road in the United States is uninsured. 1 in 8. In some states, it's as high as 1 in 4. Think about that. The next time you're at a traffic light with 8 cars around you, there is a very real statistical probability that one of them has zero insurance. What happens if that person hits you? Or what if you're the victim of a hit and run, and the driver is never found? In that case, there isn't a $25,000 policy to collect from. There is nothing. Zero. This is where uninsured motorist coverage comes in. It works the same way. Your own policy steps up and covers your medical bills, your pain and suffering, and your lost wages up to the limit you selected. Without it, you are completely on your own. Your health insurance might cover some of the medical bills, but it won't give you a dime for the fact you can't work, or for the permanent injuries you've sustained. Uninsured motorist coverage does. Now, we've been talking about your body, about medical bills. But what about your car? In our scenario, your $40,000 SUV is a twisted wreck. The other driver's state minimum property damage liability might only be $10,000 or $15,000. So they pay out their limit, and you're still $25,000 or $30,000 short of being able to replace your vehicle. This is where you have two options. First, you could use your own collision coverage, which we discussed earlier. You'll pay your deductible, say $500 or $1,000, and your insurance will cover the rest. This is the most common way people handle this. But there's another, often better way. It's called uninsured, or underinsured, motorist property damage coverage. It's a separate line item from the bodily injury portion. Not every state offers it, but if yours does, you need to pay attention. Why? Because the deductible is often much lower than your collision deductible. Sometimes it's only $100 or $250. In some cases, if you can identify the uninsured driver, the deductible is waived entirely. So, instead of being out your $1,000 collision deductible because someone else was irresponsible, you might only be out $200 or nothing at all. It's a small detail that can save you a significant amount of money right when you need it most. So the big question becomes, how much of this coverage should you get? Here's the simple, non-negotiable rule that most top-tier agents will tell you. Your uninsured and underinsured motorist coverage limits should be an exact mirror of your own bodily injury liability limits. If you have liability limits of $250 to $500, that's $250,000 for one person, $500,000 for one accident, then you should have uninsured motorist limits of $250 to $500. Why? Think about the logic. Your liability limits represent the amount of financial protection you believe is necessary to protect your assets if you hurt someone else. It's the value you've placed on a serious injury. So why on earth would you give yourself less protection than you're willing to give a total stranger? It makes no sense. You are insuring yourself against the irresponsible choices of others. You should value your own well-being at least as much as you value a stranger's. Matching these limits is the ultimate act of self-defense in the world of auto insurance. Now I want to share one final crucial detail about this coverage that your insurance company might not go out of its way to explain. It's a concept called stacking. This applies if you have more than one vehicle on your auto insurance policy. In many states, you're given the option to stack your uninsured motorist coverage. Here's what that means. Let's say you have 2 cars, and you have uninsured motorist bodily injury limits of $100,000 per person. If you choose non-stacked coverage, your limit is $100,000, period. That's the most your policy will pay out if you're hit by an uninsured driver, no matter how many cars you own. But if you choose to stack your coverage, you are essentially allowed to add the limits from each car together. So with 2 cars, your $100,000 limit suddenly becomes a $200,000 limit. With 3 cars, it becomes a $300,000 limit. The increase in your premium for this is usually shockingly small. For a few extra dollars a month, you can double or triple the single most important safety net on your entire policy. It is, by far, one of the best bargains in insurance. However, not all states allow stacking. Some have banned it, some make it mandatory, and some, like Florida and Pennsylvania, make it an option you must specifically choose or reject in writing. So here is your homework. Pull out your policy declarations page right now. Find the section for uninsured/underinsured motorist coverage, often abbreviated as UM/UIM. First, look at the limits. Do they match your liability limits? If not, you need to call your agent and ask for a quote to raise them today. Second, look for the words stacked or non-stacked. If you have multiple cars and your policy is non-stacked, you need to ask if stacking is available in your state. The answer could literally change your life. Protecting yourself from the millions of drivers who are rolling the dice with minimum, or non-existent, insurance isn't a luxury. It's a necessity. But even with this protection, there's another layer to consider. What happens if the accident is so catastrophic that even these high limits aren't enough? What if the lawsuit isn't for $300,000 but for $3 million? That's when you need to look beyond your auto policy to the one coverage designed to protect everything you own. This is the single most important, yet most overlooked, form of insurance in America. It's called a personal liability umbrella policy, and it's not just for the wealthy. It's for anyone who has worked hard to build a life they don't want to lose in a single instant. Think of it literally. An umbrella doesn't replace your hat or your raincoat. It goes over them, providing a massive extra layer of protection when a light drizzle turns into a torrential downpour. Your auto and home insurance are your hat and raincoat. They handle the everyday storms. The umbrella policy is there for the hurricane, the one-in-a-million event that can wipe you out completely. To understand its power, let's go back to that devastating accident. Let's imagine the driver at fault is a man named David. David is a good guy. He's 45, married, 2 kids in high school. He's a project manager at a construction firm. He owns his home, has about $200,000 in his 401k, another $50,000 in savings for the kids' college, and he makes a good living. He's the classic American success story. He's also a responsible driver. He has good auto insurance with high liability limits, 250/500/100. He thought he was completely covered. One Tuesday morning, he's driving to a meeting. It's raining. He glances down for a split second to check his GPS. And in that moment, the car in front of him slams on its brakes. David reacts, but the wet road makes his car hydroplane. He swerves to avoid a rear-end collision, crossing the center line and hitting an oncoming SUV head-on. It's a violent, catastrophic crash. David is hurt, but he recovers. The driver of the other vehicle, a highly skilled neurosurgeon, is not so lucky. The crash causes severe nerve damage to her hands. After months of therapy and multiple surgeries, the verdict is final. She will never operate again. Her career, a career she spent over a decade and hundreds of thousands of dollars in education to build, is over. The lawsuit is filed. It's not just for the totaled luxury SUV. It's not just for the mountain of medical bills. The lawsuit is for loss of future earnings. Her attorneys calculate what she would have earned over the next 20 years of her career. The number is astronomical. They also sue for pain and suffering, for the permanent loss of her ability to do the work she loved. The final judgment against David comes in $3 million. Now let's follow the money. David's excellent auto insurance policy kicks in. His bodily injury liability limit is $500,000 per accident. His insurance company pays that $500,000 to the surgeon, the maximum they are legally required to pay. And then they're done. They close the file. They've fulfilled their contract. But David still owes $2.5 million. This is where the nightmare begins. That $3 million judgment isn't a suggestion. It's a court order. The surgeon's lawyers will now begin the process of collecting. First, they'll go after his liquid assets. The $50,000 in college savings? Gone. His checking and savings accounts? Emptied. Next, they'll put a lien on his house. He can be forced to sell it to pay down the debt. His 401k, which he thought was safe. Depending on the state, a large portion of that can be seized in a judgment. And it doesn't stop there. After they've taken everything he has, they can go after everything he will ever have. The court can order a wage garnishment. This means for the next 10, 20, maybe 30 years, A significant percentage of every single paycheck David earns will be automatically diverted to pay off this judgment. Every raise, every bonus, a piece of it belongs to someone else. He is, for all intents and purposes, financially ruined. His family's future, the college educations he dreamed of for his kids, the comfortable retirement he and his wife planned for, all of it evaporated in a split second on a wet Tuesday morning. That is what happens without an umbrella. Now let's rewind the clock. Let's give David one of these policies. Let's say a year before the accident, his insurance agent convinced him to buy a $2 million umbrella policy. The cost? About $400 for the entire year. Less than a fancy dinner for two a month. The accident happens. The lawsuit is filed. The $3 million judgment comes down. What happens now? First, David's auto insurance does the exact same thing. It pays out its $500,000 limit and steps away. But now, instead of David being left to face the wolves alone, the umbrella insurance company steps in. That $2.5 million gap? The umbrella policy covers it. All of it. A check is cut, the judgment is satisfied, and the case is closed. David's house is safe. His kids' college fund is untouched. His retirement savings are secure. His future paychecks are his own. Yes, his insurance rates will go up. Yes, he'll live with the emotional weight of the accident forever. But his financial life, the one he spent 25 years building, remains intact. For a cost of about $1 a day, he transferred a multi-million-dollar risk off of his family and onto an insurance company. That is the power of an umbrella policy. So how does it actually work? An umbrella policy isn't a standalone product. To get one, insurance companies require you to have responsible limits on your underlying policies first. They'll typically require you to have at least $250,000 or $300,000 of liability on your auto policy, and at least $300,000 on your homeowner's policy. They want to see that your raincoat and hat are in good shape before they sell you the umbrella. Once those primary policies are exhausted in a claim, the umbrella seamlessly takes over, covering you up to its limit, which is typically sold in $1 million increments. And its protection extends far beyond your car. It's a blanket of liability coverage for your life. Let's say a guest slips and falls on your pool deck, resulting in a permanent injury and a $700,000 lawsuit. Your homeowner's insurance might cover the first $300,000, and your umbrella would cover the remaining $400,000. What if your teenager, in a moment of anger, posts a false and defamatory statement about a teacher online, leading to a libel lawsuit? Many umbrella policies provide coverage for that. What if your dog gets out and bites a child in the neighborhood? The umbrella is there. You're on vacation in Italy, you rent a boat, and you cause an accident that injures someone? Your umbrella policy can protect you, providing worldwide coverage. It is the ultimate defense against the unpredictable, devastating events that can spring from everyday life. And who needs it? You might think it's just for doctors and CEOs, but that's a dangerous misconception. The real question is, do you have anything to lose? If you own a home, if you have a retirement account, if you have savings, if you have a career with future earning potential, then you are a target. In a lawsuit, everything you own and everything you will own is on the table. The astonishing part is the value. A $1 million umbrella policy typically costs between $200 and $500 a year. Let me say that again. $1 million of life-saving protection for less than the cost of your daily coffee. It is, without a doubt, the single best bargain in the entire insurance industry. So how much should you get? A good rule of thumb is to have enough umbrella coverage to equal your net worth. Add up the equity in your home, your savings, your investments, your retirement accounts. If that number is $800,000, you should have at least a $1 million policy. If it's $1.5 million, you should look at a $2 million policy. The goal is to put a financial fortress around the life you've built. This type of liability coverage protects you when you are at fault for damage to others. But what about when your own property is damaged? What about the one asset that gets you from A to B every single day, your car? Protecting your vehicle from accidents, theft, hail, and 1,000 other perils requires a completely different set of coverages. And that's where we're going next. Let's start with the big one, the one that comes to mind when you picture a car crash: collision coverage. This is exactly what it sounds like. It's the coverage that pays to repair or replace your own vehicle after it collides with another object. That object could be another car, whether it's your fault or not. Or it could be a stationary object like a telephone pole, a guardrail, or the wall of your own garage. Imagine this scenario. You're at a four-way stop. You think it's your turn, you inch forward, but so does the other car. It's a low-speed crunch, but the damage is done. A crumpled fender, a broken headlight. Or maybe you're backing out of a tight parking spot at the mall, and you misjudge the distance to that concrete pillar. That sickening scrape of metal on concrete? That's a collision claim. In both of these cases, it's your collision coverage that steps in to pay for the repairs to your car. Now, here's the most critical part of collision coverage you need to understand: the deductible. The deductible is the amount of money you have to pay out of your own pocket before your insurance company pays a single dime. Think of it as your share of the repair bill. These deductibles typically range from $250 to $1,000, or even more. The higher your deductible, the lower your premium will be, because you're agreeing to take on more of the financial risk yourself. Let's do the math. Say you have a $1,000 deductible, and you get into that fender bender, causing $5,000 in damage. You will pay the body shop the first $1,000. Your insurance company will then pay the remaining $4,000. If the damage is only $800, then your insurance doesn't pay anything. The entire repair cost is less than your deductible, so it's all on you. This is the trade-off you make. Choosing a deductible is a balancing act between how much you want to save on your premium versus how much you can comfortably afford to pay out of pocket on a bad day. So, who needs collision coverage? If you have a loan on your car or you're leasing it, the answer is simple: you do. Your lender or leasing company will almost certainly require you to carry it. Why? Because until you pay it off, the car is their asset. They are protecting their investment. But what if you own your car outright? What if it's a 10-year-old sedan with 150,000 miles on it? This is where you have a choice. You have to ask yourself, is the car's value worth the cost of the insurance premium? If your car is only worth, say, $2,000, and your annual premium for collision coverage is $600 with a $1,000 deductible, you might be paying $600 a year for a maximum potential payout of only $1,000. For many people in that situation, it makes financial sense to drop collision, save the premium, and accept the risk of paying for repairs themselves. But collisions aren't the only thing that can damage your car. What about all the chaos the world throws at your vehicle when it's just sitting there? A hailstorm that turns your car's hood into a dimpled moonscape. A heavy branch that snaps off a tree during a windstorm and crushes your roof. Vandals who decide to key your paint job. Or the most gut-wrenching of all. You walk outside in the morning, and your car is just gone. Stolen. None of these scenarios involve a collision. For these, you need a different kind of protection: comprehensive coverage. Comprehensive, sometimes called other than collision, is the coverage for nearly all other types of physical damage. It's for the unpredictable, the bizarre, the acts of God. It covers theft, vandalism, fire, flooding, hail, wind, falling objects, and even hitting an animal. Yes, you heard that right. Hitting a deer is not a collision claim. It's a comprehensive claim. This is one of the most misunderstood details in auto insurance. The logic is that you couldn't reasonably avoid the deer running into the road, so it's considered an unpredictable event, not a driving error. However, here's the twist. If you swerve to miss the deer and you hit a tree instead, that is a collision claim. One event, two different outcomes, two completely different coverages. It's a small detail that can make a huge difference. Just like collision, comprehensive coverage has a deductible. It works the exact same way. If a hailstorm causes $3,000 in damage and you have a $500 comprehensive deductible, you pay $500, and your insurer pays the remaining $2,500. Often, people choose a lower deductible for comprehensive than for collision, because comprehensive claims are often seen as less likely, or less the driver's fault, making the lower premium for a higher deductible less attractive. Now, you've probably heard the term full coverage. You might have even asked an agent for it. But here's an industry secret. Full coverage isn't a real insurance product. It doesn't actually exist on any policy form. It's just common slang for a policy that includes three main things: your state-required liability coverage, plus collision and comprehensive. When someone says they have full coverage, they simply mean they have protection for other people and for their own car. So the next time you're shopping for insurance, instead of asking for full coverage, you'll sound much more informed by asking about specific liability limits and the deductibles for collision and comprehensive. But what if you do everything right? You have collision coverage to protect your car. But then you're sitting at a red light, and someone who has zero insurance, no liability coverage at all, plows into the back of you. It's clearly their fault, but their insurance company is non-existent. You could sue them personally, but if they don't have insurance, They probably don't have the assets to pay for your $5,000 repair bill either. So what happens? This is where another crucial, but often overlooked, coverage comes in: uninsured motorist property damage, or UMPD. This is the sibling to the uninsured motorist bodily injury coverage we talked about for medical bills. This one is specifically for your property, your car. If an identified, at-fault driver with no insurance hits you, this coverage can step in to pay for your repairs. In some states, it can take the place of your collision coverage, often with a much lower deductible. In other states, it might just pay your collision deductible for you. It's an inexpensive layer of protection against the irresponsibility of others. Now let's shift gears to a problem unique to newer cars: depreciation. The moment you drive a brand new car off the dealer's lot, its value plummets. It's now a used car, even with only 10 miles on it. This creates a dangerous financial gap. Imagine you buy a new car for $35,000. You finance most of it. 6 months later, you're in a serious accident and the car is declared a total loss. The insurance company looks at the market value for a 6-month-old version of your car and determines its actual cash value is now only $29,000. That's the check they'll write you. The problem? You've only made a few payments, and you still owe the bank $33,000 on your loan. So the insurance company pays its $29,000, but you are still on the hook to the bank for the remaining $4,000 for a car that no longer exists. You have no car and a $4,000 bill. That's the gap. To protect against this, you need gap insurance. It's an optional coverage that pays the difference between the car's actual cash value and the amount you still owe on your loan or lease. For anyone who is financing a new vehicle, especially with a small down payment, gap insurance isn't a luxury. It's a necessity that can save you from financial ruin. Finally, let's talk about the smaller, but incredibly valuable coverages that deal with the sheer inconvenience of a car accident. If your car is in the shop for a week, how do you get to work? How do you pick up your kids from school? This is where rental reimbursement coverage is a lifesaver. For just a few extra dollars a month, this coverage will pay for a rental car while yours is being repaired after a covered claim. It's usually sold with a daily limit and a maximum number of days, like $30 a day for up to 30 days. And what about when your car breaks down on the side of the highway? That's where towing and labor coverage comes in. It covers the cost of a tow to the nearest repair shop. It's another cheap add-on that can save you from a $100 plus bill and a massive headache in a stressful situation. So we have collision for crashes, comprehensive for chaos, UMPD for the uninsured, gap for the gap, and rental and towing for convenience. Together, these coverages form a shield around the physical value and utility of your vehicle. They ensure that a single bad day on the road doesn't turn into a long-term financial disaster. But knowing what these coverages are is only half the battle. How do you see them? How do you know what you actually have? All of this information, every limit, every deductible, every single coverage you pay for, is laid out on one of the most important documents in your policy, the declarations page. And that piece of paper is exactly where we're going next. Think of the declarations page, or the deck page as it's called in the industry, as the Rosetta Stone for your entire auto insurance policy. The full policy booklet is dozens, sometimes hundreds of pages of dense legal jargon. It's intentionally confusing. But the deck page? That's different. It's a summary. It's a 1 or 2 page cheat sheet that translates everything into plain English and hard numbers. It is legally the summary of the contract between you and your insurer. If there's a conflict between what's on your deck page and what's in the main policy booklet, the deck page usually wins. It's that important. So let's pull it out and decode it top to bottom. The first thing you'll see at the very top are the absolute basics. This is the who, what, and when of your coverage. You'll see the named insured. This sounds simple, but it's the first place a critical mistake can be made. Is your name spelled correctly? If you're married, is your spouse listed? If you use your vehicle even partially for a side hustle or a small business, is the business name listed? If it's not, and you get into an accident while working, your claim could be instantly denied. This little box at the top of the page carries that much weight. Right next to that, you'll find the policy period. This will show a start date and an end date. Look closer. It doesn't just say the date. It usually gives a time, often 12:01 a.m. This is a classic trap. People assume their policy expires at the end of the day, at midnight. But if your policy ends at 12:01 a.m. on July 15th, and you get into an accident at 8 in the morning on July 15th, you are not covered. You were uninsured for almost 8 hours and didn't even know it. Check that date and time. Put a reminder in your phone a week before it expires. Below this, you'll see the schedule of covered vehicles. Year, make, model, and most importantly, the vehicle identification number or VIN. Take a second and walk out to your car. Does the VIN on your deck page match the VIN on your dashboard or inside your driver's side door? A single incorrect digit can create a nightmare scenario where the insurance company's records show they're insuring a completely different car than the one you're driving. It's a simple typo that can lead to a total claim denial. Verify it. Every letter, every number. Okay, that's the easy part. Now we get to the heart of the document. The part that determines whether a car accident is a minor inconvenience or a life-altering financial catastrophe. We're talking about your coverages and your limits. This is the section that lays out in black and white exactly what you are paying for. It will typically be broken down by vehicle. So for each car on your policy, you'll see a list of coverages and a corresponding dollar amount. Let's start with the big one. Bodily injury and property damage liability. This is the coverage that protects you and all of your assets when you are at fault in an accident. It pays for the other person's medical bills, their lost wages, their pain and suffering, and the repairs to their car or property. You'll see it written as 3 numbers separated by slashes. Maybe it's 25/50/25 or 100/300/100. Let's break that down. The first number is the maximum amount. In thousands of dollars, your policy will pay for any one person's bodily injuries. The second number is the maximum amount it will pay for all bodily injuries combined in a single accident. And the third number is the maximum it will pay for all property damage you cause. So if you have 50/100/50 limits, and you cause an accident that seriously injures one person with medical bills totaling $80,000, your insurance will pay the first $50,000. The other $30,000? That's on you. They will come after your savings, your investments, even your future wages. Now imagine you hit a brand new Mercedes or a Tesla. A $50,000 property damage limit might not even be enough to replace that one car, let alone repair the guardrail you also hit. This set of 3 numbers is arguably the most important financial decision you will make on this entire page. Look at your numbers right now. Do they make you feel protected or exposed? Next, you'll see uninsured or underinsured motorist coverage, often abbreviated as UM/UIM. If liability is about protecting you when you mess up, this is about protecting you when someone else messes up and they don't have the insurance to fix it. If you get hit by someone with no insurance, or someone with pathetic state minimum limits that don't even cover your ambulance ride, this is the coverage that steps in and acts like the insurance the other driver should have had. It pays for your medical bills, your lost wages, your suffering. In many states, 1 in 8 drivers on the road with you right now is uninsured. This coverage isn't a luxury, it's a necessity. Then you'll find either medical payments, sometimes called MedPay, or personal injury protection, known as PIP, depending on your state. These are your no-fault coverages. It doesn't matter who caused the accident. This coverage helps pay for your and your passenger's initial medical expenses. It's designed to be fast, to get you the care you need immediately without waiting for the insurance companies to fight over who's at fault. The limit here is usually a smaller number, like $5,000 or $10,000, but it can be an absolute lifesaver to cover your health insurance deductible and copays right away. Now for the coverages that actually protect your car itself. Comprehensive and collision. People mix these up all the time, but it's simple. Collision covers damage to your car from, you guessed it, a collision. Hitting another car, a pole, a wall, or flipping your vehicle. Comprehensive covers almost everything else. Theft, vandalism, fire, hail, a rock cracking your windshield on the highway, or the classic, hitting a deer. For both of these coverages, you will see the most important number next to them. Your deductible. The deductible is the amount of money you have to pay out of your own pocket before your insurance pays a single dime. If you have a $1,000 collision deductible, and you cause $5,000 worth of damage to your car, you write a check for $1,000, and the insurance company covers the remaining $4,000. This is a critical point of self-assessment. Look at your deductible. Is it $500? $1,000? $2,000? Now ask yourself a very honest question. If you had to, could you write a check for that amount today without it causing a major financial crisis? Many people choose a high deductible to get a lower monthly premium, but they forget that they've essentially pre-committed to paying that amount if something goes wrong. If you can't comfortably afford your deductible, it's too high. That number on the page isn't theoretical. It's the price of admission to getting your car fixed. Finally, after all the coverages, you'll usually find a section listing all of your discounts and surcharges. This is the report card. It's the breakdown of why your premium is what it is. You'll see things like multi-policy discount, good driver discount, good student discount, anti-theft device discount. Scan this list carefully. Are you getting every discount you deserve? You paid to have a LoJack installed. Did you remember to tell your insurance company? Is your daughter on the honor roll? That could be a 15% discount you're missing. This list is where you can find easy money. Conversely, this is also where you'll see any surcharges for at-fault accidents or speeding tickets, transparently showing you exactly how much those mistakes are costing you in the long run. Your mission right now is to find your declarations page. Pull it out of that filing cabinet, download the PDF from your insurer's website, and look at it. Really look at it with these new eyes. Do your liability limits truly protect your family's future? Or are they just the legal minimum? Can you actually afford your deductible if your car is totaled tomorrow? Are you getting credit for being a safe driver with a safe car? Because once you've reviewed this page, once you've seen the numbers in black and white, you're going to have questions. You might even find some big, expensive mistakes or gaps in your protection. So how do you fix them? How do you call up your insurance company or agent and confidently ask for changes, demand the discounts you're owed, and increase your protection without getting upsold on things you don't need? That's the final crucial piece of the puzzle, and it's exactly what we're tackling in our final part. Alright, you've made it. You've dissected the declarations page, you understand liability, you know the difference between collision and comprehensive, and you've identified where your policy is strong and where it might be dangerously weak. Now comes the moment of truth. This is where knowledge transforms into power, and power transforms into savings and security. This is the conversation. First, let's set the stage for success. You never ever go into this conversation cold. That's what they expect. They expect a confused, slightly frustrated customer who can be easily placated or upsold. You will not be that person. Before you even think about dialing that number or composing that email, you will assemble your toolkit. Right in front of you, you should have 3 things. 1. Your current declarations page. 2. A list of the specific questions you have and the changes you want to make written down. Don't rely on memory. 3. Any supporting documents. If you're asking for a good student discount, have the report card ready. If you installed an anti-theft device, have the receipt or work order. You are building a case, and a good case is built on evidence. The goal here isn't to be confrontational. It's to be clinical. You're a partner in this transaction, not just a passive bill payer. When you call, your opening line sets the tone for the entire interaction. Don't start with a complaint. Start with a clear, calm statement of purpose. Something like, "Hi, my name is your name, and my policy number is your number. I'm doing my annual review of my auto policy, and I have a few specific items I'd like to discuss to ensure my coverage is accurate, and I'm receiving all the discounts I'm eligible for. Is now a good time?" You see the difference? You've immediately framed this as a professional review, not a random complaint. You've established that you are organized and you have a specific agenda. This signals to the agent that they're dealing with an informed consumer, and they will often shift their own approach to be more direct and helpful. Now you walk them through your list. Systematically, let's start with discounts because it's the easiest win and it builds momentum. Don't ask, "Are there any discounts I can get?" That's an open door for them to say, "Looks like you have everything." Instead, you state what you believe you are owed. "I'm looking at the discount section. I recently completed a defensive driving course and have the certificate here. I'd like to get that discount applied to my policy." Or, "My son, who is listed on the policy, has maintained a 3.4 GPA. I'd like to add the good student discount. I can email you a copy of his transcript right now." You're not asking for permission. You're directing them to make a factual correction to your account. Next, let's talk about coverage. This is where you protect yourself. Based on our previous discussions, you might have realized your liability limits are dangerously low. The state minimum is not enough. So you don't ask, "Should I get more coverage?" That invites a sales pitch. Instead, you direct the conversation. You say, "I've been reviewing my bodily injury liability limits, and I'm no longer comfortable with the 2550 level. I'd like to see a quote for increasing that to 100/300. Then the crucial follow-up. "And while you're at it, can you also quote me the price for 250/500? I want to compare the cost-to-benefit ratio." This is a power move. You've shown you understand the specific coverages, you've used the industry terminology, and you've asked for options, signaling that you are a savvy shopper making a calculated decision, not an emotional one. This makes it much harder for them to simply push the most expensive option. They now have to provide you with the data you requested. The same logic applies to your deductibles. Perhaps you've built up your emergency fund, and you can now afford a higher deductible to lower your premium. You say, "I'd like to explore the premium savings of increasing my collision deductible from $500 to $1,000. Can you tell me exactly what that would save me per month?" It's a simple, direct request for a number, not a vague inquiry. Now we have to prepare for the two big countermoves from their side: the rate increase explanation and the upsell. Let's say your premium went up, and that's what prompted your call. The standard lazy answer you'll get is, "Oh, rates are just up across the board in your area. Do not accept this." This is a non-answer. Your response should be polite but firm. "I understand there are general rate trends, but can you please walk me through the specific factors on my profile and my policy that contributed to this specific percentage increase? Was it a change in my vehicle's rating, a change in my driving record, or something else? I need to understand the specifics." This forces them to actually look at your file and justify the increase. Sometimes they'll find an error. Other times they'll give you a real reason, like a new cell phone ticket you forgot about, which is still valuable information. But you never ever let them off the hook with a vague, generic excuse. Then comes the upsell. As you're making these smart, calculated changes, the agent might try to regain control by pushing a product you didn't ask for. "You know, while we're increasing your liability, you should really consider our new custom equipment coverage." Or, "Have you thought about bundling with our pet insurance?" Your defense is simple and unshakable. It's called the broken record technique. You politely decline and immediately redirect back to your agenda. "That's interesting, thank you, but for today I'm just focused on adjusting my liability limits and applying that defensive driver discount." So, as we were saying, what was the premium difference for the 250/500 liability? If they push again, you repeat it. "I appreciate the information, but my priority right now is to finalize the changes we've already discussed. Let's stick to that for this call." You are in control of the agenda. You set the agenda at the beginning of the call, and you will see it through. Once you've gone through your entire list, you've added discounts, adjusted coverages, and questioned any increases, you are not done. This final step is arguably the most important. You must get it all in writing. Before you hang up the phone, you say this verbatim: "This has been incredibly helpful, thank you. Could you please send me an email summarizing all the changes we just discussed and the new, updated premium amount? I'd like to have that for my records before we finalize everything." This is non-negotiable. An email serves as a written record of the conversation. It prevents misunderstandings later. It ensures the agent actually processes the changes they promised. Once you receive that email, you review it. Every single line. Does it reflect the new discounts? Does it show the new liability limits? Is the new premium what you were quoted? Only after you have verified it in writing do you give them the green light. And you save that email forever. And what if, after all this, you're not happy? What if they refuse to add a discount you know you qualify for? What if the new rates are still astronomical? Then you execute the final power move. You leave. Calmly and professionally. You say, "Thank you for your time and for providing those quotes. I'm going to need some time to review this and compare it with other options on the market. I'll be in touch." And then you do exactly that. You take your declarations page, which you now understand completely, and you start shopping. With 2 or 3 other major insurance companies, the process is 10 times easier now because you're not a novice anymore. You can compare apples to apples. You can tell the new agent, "I want a quote for 100/300/100 liability, $1,000 collision and comprehensive deductibles, with uninsured motorist coverage to match my liability limits." You will get a clear, fast quote because you speak their language. What we've done over these 10 parts is more than just read an insurance policy. We've dismantled a system designed to be confusing. We've turned you from a passive price taker into an active, educated consumer who is in complete control of one of the most important financial safety nets you have. You no longer have to wonder if you're protected. You no longer have to hope you're not getting ripped off. You can open that packet of paper, and instead of seeing confusing jargon, you will see a tool. A tool you know how to read, how to question, and how to sharpen to perfectly protect you, your assets, and your family. That knowledge is the ultimate coverage, and it's a policy that will never expire.